welcome everybody. It is October and time for our latest market call. I'm Tori, the CEO of Equi, and I have with me my co-founder who's looking very dapper today, Mr. Itai Vinik, our Chief Investment Officer. So, you know the routine, Itai. What we do for people is we break down what's happening in broader markets and tie it back to how they should be thinking about how to prepare. So this month, where do you want to start us off?
Right. A lot of things are really continuing the trends we've talked about. Just wanted to cover what's really the update, how it plays out with some of the things we've already been seeing, and how it all connects into the bigger macro picture. Unfortunately, some sad events on the geopolitical side. We'll cover that as well. And yeah, let's dive into it.
Okay. Well, we got to start with your buddy, Mr. Powell. What can you tell us about his recent remarks?
Right. So he just recently made a speech on October 19th at the Economic Club of New York. It was actually quite it was quite funny because at the beginning there was this protest that took place with a bunch of people screaming at him that delayed the speech. Of course, econ nerds like me notice these things. But nonetheless, when Powell did come out and talked, he said a few very interesting things. One of the key takeaways there is that this is a demand-driven economy, really focusing on, quote, crushing the demand side in order to quell inflation, which is most likely the policy that causes a recession. And I believe the Fed does believe that this is going to happen. He also made some interesting comments about the fiscal situation. He said, technically, we're not supposed to comment on the fiscal side because that's not our responsibility. However, everyone knows that it's completely unsustainable and it must change at some point. But I'm not really allowed to comment on that.
Yeah, I remember when we brought this up a couple calls ago, and you were saying we're on an unsustainable path. And then fast forward, I think it was like a week later, U.S. debt got downgraded, right?
Right. So just to keep context, I mean, that continues to unfold, and 30% of US treasuries or so are going to come due next year. And it's not going to be, I can tell you right now, it's not going to be possible to get that debt rolled into 5% plus rates. It's just not going to be possible when the debt payments are already approaching $1 trillion and moving higher than national defense. I think Powell is fully aware of that. Now, the Fed doesn't have a mandate to get better borrowing terms for the US government, but I'm pretty sure if you read between the lines of what he was saying, he is really implying that they may do something. But that's very, very speculative what I'm saying here, obviously.
Right. So let's talk about some things that aren't speculative then. We talk about being a demand-driven economy. How do you think he's doing in terms of fighting that demand?
I think he's very successful. And I think they're starting to be aware of that partially. I do think they're looking at lagging data, of course, and they are aware of that. He mentioned as well that we have to wait and see. These things work with a lag, and let's see how it unfolds. But one of the biggest issues is that when the snowball does get rolling, and when things really accelerate to the downside, you can't necessarily control how far or how deep it's going to go. That's the biggest problem. And that's really why the Fed has not been able to give you a soft landing, right? It only happened one time, generally because when the inertia comes in, it's typically too much. So what we're seeing right now is, despite the NFP numbers that are coming in strong, I'm going to dive in and tell you why they're not as good as the headline numbers suggest.
Wait, let me pause you. NFP, you're saying non-farm payroll, right?
Right. The jobs numbers.
And that's what's driving most of the headlines, meaning a lot of the newspapers are reporting on, these NFP numbers and saying, oh, things look good. But you're saying you see something different.
The headline numbers have been coming in relatively good throughout 2023, but I'm going to tell you why they're actually not. So like when you dig in under the surface, these jobs numbers are deteriorating. So I do believe that we're seeing the beginning of a cycle that will lead to higher unemployment. And Powell is successful in generating that. We're also seeing that retail credit is drying up. So the consumer, again, 70% of the US economy, very, very important for inflation. I feel the consumer, I wouldn't use the word feel, but I believe the consumer is getting to the point of maxing out, which is going to be very important going forward. And inflation is crushing the consumer based on what we're seeing.
Got it. Okay, well, then let's start unpacking each of those. So you said number one, we've got a weakening labor market, but obviously that runs contrary to what the headlines are saying and what non-farm payroll data is showing us. So where are you looking that's showing you contrary indicators?
Right. So one of the things that I'm looking at is the full-time workers versus part-time workers. So it's very misleading when you're seeing a headline number of certain amount of jobs being added into the economy, but they're not really breaking that down on the headline number into part-time jobs, full-time jobs, etc. So one of the first trends that I'm seeing is that if you are an employer, before you start laying off en masse, you're going to try to cut costs in other ways. Cutting costs happens by not hiring as new people, which we're seeing job openings actually start to diminish, and we'll cover that in a second. Also, by letting go of full-time employees and trying to get contractors and full-time people instead to fill in those gaps. And we're seeing all of that. So we are seeing the number of full-time jobs, the quality jobs that you all want to see in a healthy economy starting to diminish throughout the year. And really since July, we're seeing the part-time jobs tick up again at quite a rapid pace in the economy, which is not a great sign for the labor market, but potentially a good sign for the fight against inflation.
Is it more than like you would typically see from seasonality? Because I mean, looking obviously at the beginning, those January numbers, you can see there's a lot of part-time workers, like far outstripping the full-time positions that are open. I'm assuming that's due to seasonality. Is the difference between part-time and full-time job openings, it's larger than you would typically see based on seasonality, or is this normal?
Yeah, so it is, and I'll show you some other metrics we use in order to look at just total amount of full-time jobs added or subtracted from the economy on a larger scale than just 2023. But there's also been this trend of revisions that almost every single jobs number in 2023 has been revised down post coming due. So we are definitely seeing a trend of deterioration in the labor market. It's still not really showing in the headline numbers, which is causing a lot of people to say, well, the hard data is still saying the economy is just fine, labor market's fine. But we are seeing the leading indicators that are really showing us that this is going to change in the next 12 months. This is something we strongly believe in.
And so where else are you looking to get that data?
Right. So one of the things that is very, very important to look at is where are jobs actually coming from? Are they coming from the private sector or are they coming from government? As government is not cyclical and it's not subject to the ebbs and flows of the economy itself. So one of the things I pulled out that I thought was an interesting indicator prior to the '08 crisis, the labor market was also deteriorating already in '07. But at least the private sector was, but the jobs number were still healthy throughout '07. But it was interesting to see that towards the latter part of '07, the closer you got to the recession itself, most of these jobs, at least as a percentage of non-farm payroll, were actually coming from the government sector. And as we mentioned, that there's a lot of fiscal spending going on, and the U.S. government spending is quite extreme right now, actually just as high as the World War as a percentage of GDP, which we're not fighting a world war as far as I'm aware of. This is now increasing as well this year. So the percentage of jobs being government jobs has definitely been trending up.
Okay, got it. And so this is a trend that stood out to you. Is there something else that when you take a broader perspective, what are you seeing in terms of informing where we are in the cycle itself?
Yeah, so this tells me with everything else, we are very close to the beginning of another recession. As you can see here, as I mentioned, there are the permanent job losses that rise. So we talk about the part-time and then we talk about the permanent job losses. So we did see a very hot economy post-COVID as rates were zero, a lot of money printing was going on, QE was running strong. We went far below trend there. The permanent job loss was actually a negative number, and a pretty deep negative number. Normally, when it's trending below zero, as it was between 2010 through 2020, that's what we called Goldilocks period. That's what is a bull market, right? During these periods of time, the stock market just has really good returns, and it's very stable and not so volatile. Similarly, between 2003 and 2007, we have another Goldilocks period. Between 96, 2001, another Goldilocks period, where the economy becomes really volatile and the stock market becomes really volatile, and you're starting to see a lot of issues, is with this number trends above zero, which means that you're seeing job losses of permanent job losses, meaning people with full-time jobs with good salaries are getting let go, even though part-time people are replacing them, but that's already killing consumption. That's causing a lot of economic volatility. So we really had, since 1996, 4 periods like that. We have that 2001 through 2003. We have 2008 through 2010. We have the COVID period, 2020, 2021, and now, right? So now we're starting to trend above that zero line, which is giving us an indication that as long as that's happening, economic volatility is going to be very high.
Got it. So it's early innings, but we're starting to see the indication because it's trending above the zero line. I know last time we spoke, something you like to refer to is the JOLTS data. So maybe you can tell us like how is that trending since we last spoke?
Right. So it did have an upward revision in the last month, but on a month-to-month basis, this is a quite a volatile number. But it has a very strong correlation with the returns of the stock market. Generally speaking, the JOLTS is the idea of how many open positions do you have in the economy. So you can see that S&P 500 year-over-year returns in the blue line are trending above zero throughout the entire period of time where this is trending up, right? However, periods of time where this is trending down have typically led to negative stock market returns. And we've been in a period of time since the end of 2021 in which the JOLTS data is in fact trending down, which again puts us in the cautious camp.
Got it. Okay. So overall takeaway is we're seeing the early signs of labor market softening. It hasn't full on started because it's one of the lagging indicators, meaning you really don't start to see that until the recession is in full swing, but it's enough for you to say a lot of volatility ahead.
Well, yeah, well, JOLTS is a leading indicator because it is the number of total job openings. And then it leads to NFP numbers, which are lagging. So JOLTS is somewhat of the leading number, and you can see the correlation. There's a very strong correlation between the performance of the stock market, generally economic volatility, and job opening trends. So this trend is continuing to go lower. We believe it will go even lower, which again leads to more economic volatility.
Okay, so then let's look at the second factor then. So we talked about labor market weakening. Now let's talk about retail credit.
Right. The consumer is very important. We've heard a lot of, but the consumer is still strong. We're still seeing a lot of spending, which generally we have. And the consumer is very important. Why? Because 70% of the U.S. economy is consumption, and that's something that we put a lot of attention towards. And what we're seeing right now is that the borrowing from the consumer hits the lows of 2020. Really haven't seen since the pandemic. Generally because banks are not lending. We're seeing credit markets being very, very weak across the board, whether it's mortgages, which mortgage rates are just too high. Most people are priced out of the housing market, but even credit card debt is really high, auto loans, and many others. So the credit markets are really struggling right now, and that's typically just ahead of a recession.
Okay, so credit markets getting really tight. Banks are looking a lot less willing to lend. What's the reason for that? Like, why is it that the banks are getting so tight?
Right. A lot of it is directly tied to the interest rate situation. So banks were conditioned to believe rates will never go up again, which means that a lot of the collateral they've been holding was in long-dated treasuries. That's the story that really took SVB out of business. Because as what happens, consumers are not completely ignorant of the interest rate environment, and over time, what they're going to do is they're going to move money into money market funds where they can make 5% risk-free yield. And as that's happening, the banks just can't compete with that because they're carrying too many unrealized losses. So they can't actually give the consumer the same rate as the treasury. And as a result, they're losing deposits on a grand scale, and they don't have as much capital to lend. So that suffocates the credit markets. And we've seen that continue to unfold. Now, we know the Fed had the post SVB, the Fed has this program that allows banks to borrow money from the Fed at the Fed fund rate. We'll talk about that in a second. But that program is supposed to come due early next year, around March or April of next year, and banks have to pay up a huge amount of money back to the Fed. If they don't have deposits, I don't know how they're going to do it. And we can see the deposit rates here far below trend. As the Fed has raised interest rates, deposit rates have just collapsed.
Yeah. So to put this in perspective, can you give us a sense of the size of these outflows?
Right, they're massive. So here we can compare them to prior years during Fed tightening cycles, right? Because we're always going to look at Fed tightening cycles. We want to see a period of when interest rates rise. That's when people are going to take out of banks and put into treasuries, right? They're not going to do it when the rates drop. And you can see the last few cycles, 2015, 04, 99, 94. This is just blowing everything out of the water. We're almost at $1 trillion that's just been taken out of the banking system.
You have to wonder, I mean, for the same reason, you mentioned SVB and just how liquid many of those startups that were banking with them were and how quickly they were, able to move their funds away. I wonder if this also couldn't be due to technology, meaning it's so easy now to open a new account on your phone and just transfer assets away. Do you think that's a big part of what's driving just because it seems like the velocity is just so much higher than prior tightening cycles? Do you think that that's part of it, or is there some other explanation you're aware of?
It can be. I also think it's a different tightening cycle because this is actually the fastest tightening cycle out of all of these tightening cycles. This is the fastest tightening cycle since the early 80s. If you really think about it, it's mind-boggling to think that just a year and a half ago, we're still at zero rates.
Right. So a lot of it is just, it happens so fast and people are now quick to capitalize.
People are like, what? I can make 5% on my money doing nothing? I've never seen that in my entire life.
Right, they don't remember. I mean, because it's been so long since you could actually earn a yield.
Right.
Wow.
And most investors today haven't lived through a period like that. Or I wouldn't say most, but a very large amount.
Okay, so let's go back to what you were saying before, back to the banks, right? So you were saying a big part of why they're unwilling to lend, yes, it's this capital flight, but these unrealized losses. Can you maybe expand on that? So what's behind that?
What's behind that are bond losses, right? So banks need to have collateral, and that collateral can come in the form of debt securities which they hold. And the way bonds work is that if you hold a bond and the interest rate rise, it's kind of like the seesaw. So if the rates go up, the price of the bond would go down. And if you're holding bonds at 1% rate and they're 10-year maturity bonds and now you're at 5% rate, these can have 30-40% losses just because you, as a new owner of the bond, you need to be compensated for the much higher rate. The only way in which you can get compensated is if you're basically getting sold that bond at a much lower price. And therefore, you have a ton of unrealized losses there. Now, the Fed has come up with that program post-SVB in order to help the banks borrow and basically plug that hole. But that program is coming due next year. Clearly, the Fed can extend it. I think they probably will extend it. They're not going to have a choice. But the banking system is under severe stress. And there are banks today that are really underwater on these metrics. Charles Schwab is one of them, come to mind. PNC Bank is another one that carry potentially higher ratios of these losses than what SVB did before it went bankrupt. So again, I don't believe that this cycle is going to be over until a number of more banks is likely to default. And I wouldn't even say one, I would say a number. And there could be one of two of quite large size.
Yeah. So, I mean, that's on the balance sheet side. But when, I imagine there's other reasons when the banks are looking out there and they're looking at the borrowers, what are they seeing in terms of, how's the creditworthiness of the borrowers?
Right. So it's diminishing substantially, again, because of rising rates, inflation, and this big stress on the consumer. And we're already seeing delinquency rate rise. Now, granted, post-COVID, rates went to zero. A lot of money entered the system. People are getting stimulus checks, et cetera. So generally delinquency rate went down a lot, but now they're normalizing. So delinquencies are increasing, and credit card interest rate are at all-time highs or so. So the consumer is potentially getting squeezed from multiple sides, right? Both on, and they don't have a choice. They have to borrow money on their credit cards because inflation is just eating out quite a bit of their purchasing power. So it's a very unfortunate situation.
Yeah, I mean, if you had to look at your crystal ball, here it looks like it's returning to trend, and trend, let's say, is roughly around 1.5%. Do you think that as this returns to trend, that it's going to overshoot it, and that in fact delinquencies will well exceed prior
I
trend?
believe so because that's tied to the unemployment rate. So if we believe jobs are going to continue to go down, more permanent job losses will happen. Once the unemployment rate picks up, that delinquency rate is going to rise above trend.
Okay. All right. So then let's look at the bigger purchases, things like cars and houses. How are those looking?
I think that's the biggest issue. So, Powell says demand-driven economy, but we're seeing demand for these things really collapsing. And again, it's not a surprise. If you own a home at a 3% rate, you're not selling it. And if you are a new buyer, you can't afford to pay 8% rate. So we're seeing the most unaffordable housing market in history. And housing particularly drives so much of consumer demand because when you move to a new home, especially if you're a new home buyer, I think I've just seen the data on that, and new home buyer purchases, I believe, are down to all-time lows, right? So imagine you're a first-time home buyer and you're coming in and you need to buy furniture and you're paying your realtor fees and you have escrow and you potentially buy a new car, and all these things create so much consumption and so much organic growth in the economy. So when the housing market is at a complete standstill, that will impact demand, and that does impact homes, and that does impact so many different things. And as you can see here, compared to the other years, 2023, so 2022 already had a big downtrend because of rising rates, but 23 is just a complete standstill.
Yeah, you can see it. It's similar to the prior chart where we were looking at trends. It's like the current year stands out versus all prior years pretty starkly. So if that's where the consumer is, what about businesses?
Right. Businesses are in a similar place as well, and because consumption is falling, bankruptcies are increasing, unfortunately. And typically, bankruptcies are rising pretty quickly ahead of a recession. So we can see COVID again made bankruptcies go lower because debt is free, right? So if debt is free, you don't go bankrupt because you can just borrow as much as you want for effectively zero rate. But these times are over. And again, similarly to delinquency rate in credit cards, we're back to trend. The big question is, do we go over trend and trigger a recession? I believe so. Powell said it does require below trend growth to accomplish this disinflation scenario. However, the problem is when you start this cycle of defaults, you start this cycle of delinquencies, you start that very difficult downside cycle, it's like a snowball. It's not like you can control where exactly to stop it. And once you have enough businesses that go under and enough layoffs, it becomes very difficult to actually reverse.
But what's interesting is it does seem like the economy wants to fight the Fed, but one of your favorite sayings is "Don't fight the Fed," and it seems like we're starting to see that even that valiant effort is starting to fall short. Okay, last area then that I'm curious for you to touch on is commercial lending. So what are you seeing over there?
Right. First off, never fight the Fed, right? The Fed always gets what they want because they control money itself. It may take them longer,
Right.
but eventually it's going to happen.
But now you're also saying that they don't have much time, right? Because if all these treasuries are maturing next year, and I know that's not in their mandate, but to a certain extent, when I shouldn't say they don't have time, but we collectively here in the United States don't have much time if we don't want our debt to refinance at these much higher rates.
Right. So but right now the Fed is saying higher for longer, right? So they are saying we're going to keep rates. We may not increase them again. By the way, we're likely very correct with our call that that was the last hike. We'll touch about that in a second. But they're currently saying that rates will stay high for a long period of time. We'll see whether or not that stays true, to your point about the refinancing. Okay, so tightening standards are quite a bit, right? Are trending up a lot. Again, commercial lending is very, very difficult. Similar story to what we're seeing with the deposit flight. And again, it's above the recessionary levels already. So when you have tightening lending standards that are this tight, it usually is accompanied by a recession. And again, similar to what we've seen with the jobs number, the Goldilocks period is consistently below zero. That's not so. You get very light, mild economic volatility. You get very good trending equity markets. We're not in that time, right? We're in the recessionary levels.
Well, one question I have for you is, I saw, I can't remember where I saw it, but I know that lending is drying up across the board and banks aren't lending. But I saw a chart that showed how private credit is exploding, and private lenders are stepping in to fill the gap where banks normally, play as a kind of lender of choice. So my question is, like, do you feel that that's you know, bought the economy some time because enormous amounts of capital are flowing into the private credit space? Or do you think that really it's delaying it, but just delaying the
It
inevitable?
has delayed it in 2023 particularly, and one of my big concern is that the quote shadow lending industry, right? That's another way to call private credit. Has always been there, right? And it's gotten bigger. The rate environment and a lot of the fact that banks are not lending, but you have to ask yourself what type of risk is in that shadow lending industry and what type of default cycle can happen in there, right? And they're way less regulated than the banks are. So even though it puts money and capital into the economy, it also adds risks. And we've seen that happen in China multiple times. So China has a very robust shadow lending industry that created substantially more economic volatility there as a case study. And this is something we're monitoring carefully as well.
Okay. All right, so let's move then to this final leg of the stool. You had mentioned inflation. Difficult to have one of these presentations and not mention it. But since last time we spoke, what are the latest indicators you're seeing in terms of the impact that inflation is having?
Yeah, so I think it's important to take this pause. Continuously, we're talking about inflation in this, well, core PCE is 4%. Inflation came from 5 to 3. Inflation's now at 3%. So especially the administration keeps celebrating, but inflation's down 3%. But consumers feel the cumulative impact of inflation. They don't care so much about the month to month. And the reality is that salaries haven't really kept up in real terms with the erosion in buying power. And if you think about what has actually happened since pre-pandemic, so January of 2019 to where we are today, it's not a very long period of time, right? It's a 4-year period of time. And your $100 at that time can only buy you $81.90 worth of goods now. This has been one of the fastest periods of erosion in recent history, just to put that in context. So if you're feeling like the $100 is not $100 anymore, there is a very real justified reason for that.
Yeah, it really is staggering. I mean, I feel like I can't go a week without someone making the comment like, I can't walk out my door without spending $100. And that I guess it's you're feeling it everywhere. You're feeling it at the pump, feeling it at the grocery store. But yeah, this is a staggering decline over such a short period of time, and especially on, I guess, the coasts in more expensive cities like San Francisco and New York, where also rents have accelerated up so rapidly.
Right. That's been everywhere on a relative basis, right? So places with low cost of living, it's based on relative incomes and things like that, but everyone's feeling it. It's been a global phenomenon. Argentina is dealing with triple
Triple
digit
digit.
inflation that hopefully we'll never see. And we're seeing it globally. So, but again, this is the core problem. What the Fed is trying to fix. Usually, the price for that is a recession.
Okay. So, like I said, feeling at the pump, can't talk about oil and gas without talking about OPEC. What's been happening there?
Right. So we are seeing that during a period of time where crude oil has already been uh, under a lot of pressure, we are seeing supply cuts across the board. Obviously, from Russia, the most because they want to squeeze Western nations because of the sanctions that they're on. But we're seeing it across the board from OPEC, and we've even seen it from Saudi Arabia. Um, and generally, we did see in 2022 the U.S. using once we had a spike of oil going to the 120s. We've seen the U.S. release a large amount of the strategic petroleum reserve and really draining it in order to reduce oil prices. It did work for a while. Oil dropped back to the 70s, low 70s, high 60s, and since it's come back to the mid 80s, peaked at about 95, now get it back to about 85. And the problem is the strategic petroleum reserve is very close to being empty. And it's much more difficult to fill it up with higher gas prices. Now with geopolitical pressures rising up across the world, it does seem like it was a pretty poor strategic decision. And OPEC are not friendly countries. We have to remind ourselves that they do not have our best interest in their mind, right? They want to squeeze as much as they can. And typically, rising oil prices during a period like this can cause substantial issues. And we can't mention that, obviously, without mentioning geopolitics. You can see this oil chart starting in September. Obviously, on October 7th, we've seen this appalling terrorist attack on Israel. It's just terrible, very sad about that. But besides the loss of life that has taken place from that event, you can see it immediately pressures oil prices higher, just because the Middle East is a place where most of the oil in the world is being produced, or a very large amount of it. I wouldn't say most. And the big issue there is, does this war spread out outside of the Israel-Gaza area? If it spreads through to Iran, it could cause substantial disruptions to global oil supply. And it's just an example. You see the Russia-Ukraine situation where Russia is a huge oil exporter, but then now the Middle East as well. So geopolitics, completely outside of traditional macroeconomics, could play a very substantial role in price of very important commodities like crude oil.
Yeah. And, this is also one part of the, I guess, inflation mix that has the most volatility as it is, right? Like already as it was, energy prices were behind a lot of the initial spike and decline that we saw in headline inflation. Does this in any way remind you of previous crises?
It does. When we study prior recessions and what really kicks the economy into a very deep recession versus a mild recession, when we study that going back, we see that oil shocks come into mind. So when you already have a situation where it's very fragile, and you're already seeing some job losses, like we covered, consumer spending is already down. You just need one more shock to really take it from where it is into a very hard landing. And oil is really a common thread across these type of historical recession. If you can see here, 07, 08, right before things got really bad, we saw one of these oil shocks. So oil really went skyrocketing into the hundreds, like $140 a barrel, peaked around there. But then as the economy collapses, like it did in 08, oil collapses as well, not because of the supply side, because of the demand side. You're seeing complete demand destruction as people don't travel. They stop flying, they stop driving, and then oil demand just collapses. So you can see what happened in 2022 when oil prices went up already because of demand, and then we got the Russian invasion taking it from 90 to 120. Then the Strategic Petroleum Reserve was released. Oil stabilized back into the mid 60s, 70s. Economy recovered. Now we're back trending towards the 80s. Obviously, if oil gets back into the hundreds, I think the pressure on the economy is just going to be too much.
Got it. So this is obviously then a key a key market to keep our eyes on. Is it, your opinion? You think that it's on that type of trajectory, or are you just flagging this as a
I'm
as a
flagging it as a
risk?
risk because it's difficult to project this very volatile situation unfolding in the Middle East. There's a few different scenarios that can happen, and we're seeing supply squeeze across the board. But again, the US is increasing production as well right now, and demand is starting to potentially slow down. So it's difficult to make the call that that is going to happen, but it doesn't take much for a couple of headlines to happen and oil prices to shoot back up. Now, I do believe that a full-on conflict with Iran is still unlikely, maybe 20-25% chance, but a proxy war in the north part of Israel, Lebanon, Hezbollah specifically, it's a terror organization that is funded by Iran, and it's an Iranian proxy. Now, if that spreads across there, sanctions on Iran could come next, right? There's actually two parts to it. One is Saudi normalization. Saudi was supposed to normalize diplomatic relations with Israel and also increase oil production. That was a part of what was on the table during the negotiations prior to October 7th. There's been speculation that Iran pushed Hamas to do the attack in order to derail these conversations because it would marginalize Iran. And there was definitely negotiations between the US, Saudi, and Israel, which would have resulted in increased oil production from Saudi, which would have put downside pressure on oil prices. So that's off the table now due to what's going on with the attack. There's other videos. I'm not a geopolitical expert that I would recommend to watch if you're more curious about that. But either way, if Saudi cuts are off the table, sanctions on Iran may be on the table. That may be enough to push oil prices higher. It doesn't have to be a full hot war. Is kind of the point here.
Right. To have that effect. So okay, taking a step back, then we covered the three factors, right? Labor market weakening, retail credit, we're starting to see it dry up, or it's substantially dried up, and inflation is eroding purchasing power. So now maybe you can take us into Equi's macro views more broadly. How are you thinking about markets?
Right. So we are seeing this inflation risk with commodity prices potentially leading the next inflationary wave higher. This is something similar to what we've seen in the 1970s. 1973 Yom Kippur War comes to mind that caused almost a tripling of crude oil prices. So we're very watchful to see how that unfolds. The commodity basket is very correlated with the price of crude oil, simply because crude oil is also used to move commodities around the world. And as you're paying more in energy in order to ship and move commodities around, the price of the underlying commodities tend to go up with oil as well. So again, when energy and commodities very correlated, we're watching that very carefully right now. So that could lead to another wave of inflation. We're seeing consumer 5-year forward inflation expectations are trending higher as well. So they are looking for higher potential inflation for 5 years down the line. So if you see this is in the mid twos, that is above the Fed's 2% inflationary target as well. So we are very worried that we see another wave of inflation come about.
Got it. Okay. And so obviously another wave of inflation, you have to also be somewhat thinking about recession, right? Because we're trying to quell inflation with recession. So how are you thinking about recession risk? Obviously a lot of the headlines go back and forth over a soft landing, hard landing. We've been pretty clear with our position, but what is the view of the Equi investment team right now?
Right. We believe a hard landing is very, very high likelihood. As you can see here by the probability of recession model from the New York Fed, it's much higher today than it was even before 0809 and before 01, primarily driven by yield curves. What's interesting is you're seeing the probability of recession trending down now, going from the 70s and to the 60s. That's something that also happened in early 08 and 01. That actually means a recession is more likely. And the reason is because this model is telling you what's the probability of this happening in the next 12 months. So if it's trending down, it means that now the probability is actually sooner than that. So if you go back, for example, in '08, it trended down in early '08. That didn't mean that it was less likely. It means it was already here. So we're starting to see that here, which tells us that it's really close. It's probably within months.
Okay, and you also made the call around the hiking cycle and where we are in that. Has your view changed at all? I mean, last time we spoke, you said you didn't anticipate any more hikes. Is that still the view?
It is still the view, and now it's supported by the Fed fund futures markets as well, and it wasn't at that time. But now we're seeing the probability of another hike is just 20%, 21% through December, and it looks like cuts are coming in the latter half of 24. So it appears that the market is agreeing that the Fed is effectively done. I believe Powell also made it clear during his speech. We do not anticipate any more hikes. The question now is, when do we get the first cut?
And do you tend to agree with those future markets, or do you think that it could happen sooner?
Not only I believe it can happen sooner, I believe that the cuts could be substantially more aggressive than what the market is currently pricing. It really depends on what happens with the economy. If the economy falls into a recession relatively quickly, that tells me that you could see much more aggressive cuts than what the market's actually pricing.
What do you think Jay Powell's looking to see, or the Fed more broadly, to confirm that we are in a deep enough recession to justify starting to cut?
Has to be the unemployment rate, right? So the Fed has two mandates. They have price stability, which is inflation, and then they have employment. So even if inflation stays relatively elevated, but the unemployment rate starts picking up quickly, they're likely going to use that as a reason to cut.
Okay, got it. So that's the key thing to keep our eyes on moving forward into Q4. Okay, so then lastly, we've spoken previously about how unsustainable we see government spending and government borrowing being. What's changed since the last time we took a look at that?
Oh, we're spending even more. The deficit keeps going up. We're seeing more defense spending. We're running, unfortunately, now one war turned to two. We're seeing even more uncertainty on the geopolitical side. And I didn't even mention the China-Taiwan situation that can unfold at any moment, really. A lot of these inflection points around the world that require a much larger defense spend going forward, and the deficit keeps growing while revenue is actually declining. So that is a completely unsustainable situation. Also, it's the first time this is happening into rising rates. Typically, that type of deficit expansion happens when rates drop, which makes sense. So going into higher rates, I just don't know how that could be sustained for any extended period of time without causing a debt crisis.
Yeah, and something we should clarify is like it really confuses me how we can be spending as aggressively as we are right now outside of wartime. Now, of course, there's wartime elsewhere in the world, but meaning the U.S. is not at war technically, right? Proxy wars aside.
Right. But to keep that in mind, the spending on war is not the entirety of what's going on. There's a lot of social spending. There's a lot of other things. There's also lack of revenue.
That's my point. I'm talking about the total spending, right? Because this is the type of spending you would expect to in a time of war, perhaps. But the fact that we're doing it in quote unquote peacetime is
correct. So as a percentage of GDP, we're spending as much as we did in World War II, which is, in my opinion, just absolutely insane. Again, everyone agrees, including Powell, that it's unsustainable. I think the solution for that is highly unpopular across both sides of the political spectrum, because it requires a combination of significant spending cuts that no one's willing to make, with likely raising taxes to increase their revenue, which is also something no one wants to do. And I don't see how that's going to be possible. So again, it's a very unique situation we're in. Well over 100% debt to GDP situation, and this was happening before the Ukraine war. So I just want to make this clear. This trend started even before COVID. COVID really accelerated it. Ukraine war just added fuel to the fire, but it's not because of Ukraine war. This was a trend that started well before.
Right, right. It's really hard to wrap my mind around because the numbers are just so large and intractable. Like it's unclear to see how we get out of this situation.
Right.
Okay, well, let's take a moment then to wrap things up with some trading views. I know that's usually what you like to do is tie it back to markets. So what are Equi's trading views at the moment?
Yeah, it's really interesting. This year has been quite phenomenal with something we've covered a while, which is that Mag 7 companies. Everyone at this point has heard of the Magnificent Seven. And in late 21, they've reached about 29% of the S&P 500. We've warned extensively about that risk. If you buy the S&P 500, you're really buying 7 companies and a few others. We've seen a big correction in markets in 2022, right? Markets were down 25%, where the NASDAQ was down, I believe, close to 40. And the Mag 7 went from 29 to 20%. But guess what? Markets are not at a new high. In fact, they peaked around 4,600. We, again, warned about that in the summer, and now they're closer to 4,200. Yet the Mag 7 are higher than they were in 2021. Again, massive concentration risk in equity markets, really unprecedented, in fact. We've never seen such a concentration of such few companies that everyone owns as a percentage of the broader stock market.
And for those who are watching and wondering, well, wait, it seems like a good thing if we have these magnificent companies that are carrying the entire index, why should I be upset? Because I see, my retirement account or my, brokerage account is ultimately in the green this year. Why should I care if it's 7 companies carrying it? What would you say to that person?
Well, a market is much healthier when it's carried by a vast participation of companies, because then you don't have as much concentration risk. In this case, imagine you get a single ruling against these tech monopolies that all of a sudden they say that they have to break up to multiple other companies or non-compete, or different things can happen. Concentration risk can just cause the whole market to drop. For example, today is a good day because we're seeing the earnings report from both Google and Microsoft, and we can see that because it's a volatile earnings and one is up 5-6%, the other is down, we're seeing the whole index whipsawing back and forth just as a result of 2 companies. So that's something that we really haven't had before. And generally, for a healthy economy, you want the weight being carried by all the companies, not just a few. Because eventually, if the rest of the companies aren't healthy, even the Mag 7 won't be able to hold it. And when that happens, it could be quite challenging.
Got it. Okay. So that's talking about S&P 500, but what about broader market dynamics, like between stocks and bonds?
Yeah, so one of the things we've seen that's really interesting is that, especially Mag 7 type companies or NASDAQ in general are fairly susceptible to interest rates, or historically have been, because as the risk-free rate is higher, you're getting compensated less to take a risk on growth, and you have other alternatives. In the zero interest rate world, we used to have an expression called TINA, which means there is no alternative. So you have to buy the stock market because you're not getting paid for anything else. But now there is an alternative. That alternative is 5% in cash. And that creates a situation where valuations are typically led by what the risk-free rate is. So if you are buying stocks and you're compensated for the risk, the valuation in which you buy it should be lower. And you can see that going back into 2021, we've seen a very strong correlation between the 10-year rate and the S&P 500, as measured here by S&P futures. Now, because of the breakout of Mag 7 AI type of companies, we're seeing a very large divergence between interest rates and the stock market, and we have seen that starting to come in. That's the interesting part. So, if you recall our "don't fight the FOMO" big call we made, I believe, in the last week of July, that was right at that top in that yellow line, and we brought a lot of these reasons up, saying it's a very risky situation to basically follow that kind of like stock market FOMO. So far, we're seeing the market rolling over, trying to close that gap. Does it close between now and the end of the year? Does it happen in 2024? That remains to be seen. But we believe that there's still a pretty wide spread between where valuations should be given interest rates and where they are today.
Got it. So it's irregular to see a divergence this wide?
Especially when rates rise this quickly. Like clearly there could be periods of time where that can happen. But given how sensitive valuations are, like the P multiple for the Mag 7 is 46, right? It's just completely diverged from the rest of the stock market in such a great magnitude. And again, I'm not saying these are not great companies. I believe they are great companies. Do they justify these type of valuations in this type of rate environment? And can they continue to keep the entirety of the market up? I don't think so, personally.
Got it. So your view is this this divergence will close. It's not a matter of if, it's just a matter of when. And to do that, we need to see a pretty decent continued correction in the stock market. So last one, then, I know you had wanted to share this chart and compare the path of the S&P 500 to the Russell 2000. Why are you looking at those two indexes?
Right, that's exactly my point. So the Russell 2000 are the smallest companies, and they are the most liquidity sensitive. So when liquidity is abundant and the economy is surging, small companies benefit and they do really well. You can see in the left part of the chart, post 2020 COVID, it's really the small caps that led the breakout, that led the market higher. And that's a very healthy market. When you see that, that's a market you want to be long. And you can ride that for a while. Small caps are leading the advance. That's great. What we're seeing in 2022, two of them are really moving in sync. Rates are going higher. S&P and Russell come together. And then around April, May of this year, we see that big divergence happening where we see the generative AI breakout that causes the Mag 7 companies to really break away in really an unprecedented way from the Russell 2000. If I put the chart of the NASDAQ, it would be even more extreme. And why I'm bringing this up is because just in the last few days, the Russell 2000 is making new bear market 2022 lows. If you own the S&P 500, you wouldn't even imagine that we're there. But that's what the small cap index is doing right now. And I just don't know how that could be sustained. We haven't seen that in history. And I believe that divergence has to be resolved somehow. So either liquidity comes back in and the small caps get into a bull market, or the S&P 500 catches down to where small caps are. I think it's more of the latter. However, when is that happening is a big question. If you believe that the Mag 7 still have more upside and can take the market even higher into kind of an end year rally, that's certainly possible. And we've seen that in 2000, where you could lead to what we call a double top potentially, or a test of the highs that we saw in 2021. That's certainly possible. The other possibility is that the lows actually break down. That breakout that we saw out of the range of 2022, we're testing that breakout point now. So as you can see, 2022 to early 2023, the top of the range was around 4,200 on the S&P. Then we broke out towards 4,600, and we came back to 4,200. So we're testing that breakout point. Will enough buyers show up to basically make a low here and trend this higher to a higher high? Or do we break back down into the range that we were in and potentially into the lower end of the range, similarly to what the Russell 2000 have done? So I think that what's happening here in the next few days and next few weeks will actually determine the next few months, potentially the next few 6 months to longer. And that's sort of the trading view we're looking at.
Okay. And so just to make sure I'm hearing it right, you're saying then that the path could take it, the S&P to sort of close that gap would take it all the way down to like 3,500 or something like that, would bring it in line with the Russell 2000. Is that?
That's correct. As you can see by this chart, the Russell is testing its lows. That would be around 3,500 for the S&P 500.
Wow. So in terms of percentage correction, we're talking pretty substantial here, like a solid double-digit decline. So then, I mean, my question becomes, right, so just to wrap things up here.
Look, we've seen since July, August, the S&P 500 have given back half its gains of the year already, right? That happened pretty quickly.
It did, yeah, it happened very fast. But then that leads to the logical question, if I'm watching this and I align with these views, what should I be thinking and what should I be looking at in terms of positioning my portfolio? Where do you see the opportunities lie? Maybe we can finish with some of your thoughts around that, like how Equi's positioning itself, et cetera.
So, at Equi, we take a longer view on our multi-strat portfolio. And again, we're not trying to necessarily time this cycle or another cycle. The goal is to have a all-weather portfolio that is not correlated with what the public markets are doing, whether it's stocks or bonds. And we've had the view that the 60-40 portfolio is in for a world of challenge as we see interest rates rise and we're seeing the debt load and we're seeing all these things happen. So, we've had that view for a while, and the goal is really to have minimized volatility during these periods of heightened economic volatility, not taking too much risk, still grinding up, but not really trying to boil the ocean and take all these risks. And I think we've been able to do that really well, both in 22 as well as 23. And if you really think about it, the market is basically flat since the middle of 21, right? So we've had a ton of volatility, but the market is flat since the middle of 21. And the bond market, for the first time in the history of the Republic, the long-dated treasury market is down 3 years in a row. That's never happened before. So a non-correlated portfolio with alternative assets, liquid alternative assets, as we have, has been able to weather the storm quite a bit, but also maintain a lot of potential upside in it. Now, I would say periods like this, we're not expecting to make insane returns necessarily, but we're looking to conserve and grow. And as more stability comes in and more clarity into the economy, then we typically push back up. But the main goal for us is to avoid these large losses that happen during these periods of volatility so you can compound from a higher point. Now, that's on the high level, right, for kind of the core portfolio. On a more tactical view, what we're seeing is that this could be potentially an opportunity to buy the long-dated bonds. I know everyone is saying, what a terrible thing it is and how yields are going to continue to go up. But we're taking a little bit of a contrarian view here. Generally, if the Fed is done raising rates, the long-dated treasuries do really, really well going into a recession. If you look at something like the TLT ETF, this is a staggering statistic. If you invested it in 20 years ago, you'd be flat. That's how much money it lost. It's down over 50%, 50, 60%. And that's a very popular wow. ETF. So a buying opportunity in some of these long-dated treasuries, we believe, is something that we are definitely considering. The only problem with that is that the fiscal situation is very problematic, right? Supply continues to rise on these treasuries. Mm-hmm. So one of the things that worries me is, will the bonds behave this time around as they've behaved in the past, because fiscal spending is just so high and there's just so much debt issuance? That's kind of the missing factor. Gold, we believe, is a good hedge for times of fiscal extreme. We went long gold in the 1800s, close to 2000. We expect gold to break to all-time highs soon. So these are, just a few things we're looking at as some of these asset classes.
And are you still a fan of short-term treasuries?
Yeah, of course. I mean, there's nothing wrong with making 5%. The only thing is, how long are you going to be able to make that for, right? When the Fed starts cutting rates, et cetera. But, having short-term treasuries is definitely an easy choice.
Got it. Okay. Well, we covered a lot of ground. Appreciate you making the time. And thanks, everybody, for joining us. If you have any questions, you can always follow up, founders@equi.com. Until next month, we'll talk to you soon.